Hello, everybody. Welcome to Clef Investments. So let's talk about how to pass your money to the next generation. And there are two related taxes called estate tax and gift tax, because both are related to how you give money to others and how much tax you need to pay. So the first one is a gift tax. Basically, if you give out money to other people, whether it's your children or any other people, there is an annual gift tax exemption. For 2024, it is 18,000 per giver, per receiver per year, which means if you and your spouse want to give money to your child, you can give $36,000 because both of you are giver and you can give your child, one child, 36,000. If you have two children, you can double that. You can give 36,000 to each child every year. And this is within the annual gift tax exemption. You don't need to pay any tax. By the way, if you're paying for the tuition or medical or basic living for your child, there's no limit. And for this gift tax, you can give it to anybody, to your friend. I don't know why, but it's allowed. And this exemption amount increases every year, may be adjusted by inflation. So make sure you check the limit on website for that year. And if for some reason in 1 year, you want to give more than this limit, and in the following years, you will not use this limit, it's possible to document a loan. So basically, you give lots of money to your child, more than this limit, but the actual money is a loan to your child. And that loan should charge an interest. You could document this is a loan and ask your child to pay the bank after a few years, use what kind of interest. And when you get that interest, you need to pay income tax on that interest. But once you have the loan, on the next year, you can reduce the amount of the loan by next year's gift tax exemption, because in the next year, you have a new exemption that you can use. So basically, you can pay back your exemption every year until the loan is fully paid back. So in this way, you can give your child lots of money and then gradually use your exemption in the following years. But you need to make sure to document this well so that if IRS asks you what's going on, you can show them the document to prove that you are following the gift tax properly. And if you gift too much, more than this limit, then it reduces your lifetime gift tax exemption. And this gift tax exemption is the same as your estate amount. So for this estate amount, in this year and next year, it's quite high. It's around 12 million for each person. But after 2025, it will go back to about 5 million per person or 11 million per couple. And for any amount beyond this 11 million, you need to pay estate tax. So both gift tax and estate tax has a tax rate of 40%. But there's a very big difference that estate tax is tax inclusive and gift tax is tax exclusive. So let's use an example to explain what it means. So assume your gift tax exemption is used up and you want to give $6 million to your children. So you want to make sure they receive $6 million after they pay or you pay 40% of the tax. Then let's check how much you need to pay and how much money you need to set aside if this is estate or if this is gift. So if this is estate tax, you need to have $10 million of asset. And then you pay $4 million of estate tax. and then you have $6 million left for your children. But for gift tax, if you give $6 million, you need to pay 40% of 6 million. So 6 times 40% is 2.4 million. So that means you only need to prepare $8.4 million of total asset, where 2.4 million is for the gift tax and 6 million is for the final amount that your children can receive. So this means if you want to give your children lots of money, do it earlier while you're alive, can save you lots of tax dollars. And by the way, there is no estate tax or gift tax in California. If you live in other states, please check your state law. All the above taxes are at the federal level. So this is about the gift tax. And for the estate tax, what are the principles to save the estate tax? So there is a government publication. It shows some common tricks that rich people use to save estate tax. So I encourage you to go there and see what are the good tricks that rich people use, because we can learn from them. And if government puts this publication into this, it means those are the methods that work. And the general principle is you have to plan earlier. You need to transfer the asset earlier, either into some trust or into some life insurance or as gift or whatever. So if you transfer the asset earlier, you can let it grow. And after you transfer it, it can grow. The growth amount is no longer belong to you, and you don't need to pay the estate tax. And one method I will explain in the next week is called irrevocable life insurance trust, which is something my family has done. And I can share with you more details about that next time. Okay, that's all for today. Thank you.